We wrap up this section with a final video that addresses some other deferred tax issues beyond what we just talked about. So the first thing that I want to address is what happens to pre-deal when a target has deferred tax liabilities going into a deal. So if you have pre-existing deferred tax liabilities in an asset sale or 338 H10 election, since both the book and the tax bases are being revalued to fair market value, the existing DTLs are generally assumed to have gone away with a corresponding increase in equity. And if you think about it, that makes a lot of sense, because the very things that lead to deferred taxes, and again, those of you who haven't spent time talking about or going through or learning about deferred taxes in accounting, I urge you to enroll in our advanced accounting online course. It'll walk you through sort of a pretty detailed treatment of what deferred taxes, how they're created. But I'll give you sort of a broad, simple, simple explanation, which is the very things that create deferred tax liabilities tend to be differences between the book values and tax bases, as we've been talking about, of assets. And so if all of a sudden you have an acquisition, whatever the existing differences were, they all get revalued, presumably to the same fair market value. And so all those pre-existing DTLs really just go away with a corresponding increase in equity. So when we're going to build our model, if our target company has some pre-existing DTLs, we're going to want to eliminate them. And that's what you typically see in merger models that correctly handle the accounting. You make the assumption that whatever it was that led to those differences back in the day, pre-deal, are now going away in an asset sale. It's completely the opposite in a stock sale. Existing deferred tax liabilities that the target might bring into a deal are retained because there is no tax basis step up because of the deal at the stock sale. So those differences persist. Not only they persist, they're magnified by the new DTLs that we just talked about that are created in the deal. Let's talk about deferred tax assets. Up till now, we've been talking about the common scenario of the book basis of an asset goes up, the tax basis doesn't because it's a stock sale, and so of course you have to recognize deferred tax liabilities. But what about DTAs? So the treatment of pre-existing deferred tax assets that a target may bring into a deal depends very much on the nature of the deferred tax assets. So let's talk about one of the most common reasons why companies have deferred tax assets going into a deal. An often substantial DTA represents future potential benefits from historical losses. So DTAs are recognized when companies have losses, they get to basically store future tax savings, and you have to account for them as deferred taxes because you can basically offset any future income with the prior losses that you had. It's called NOLs, and the fact that you can carry forward those NOLs leads to the creation of a deferred tax asset. So if a company going into a deal has these, the acquirer cannot actually benefit from those NOLs. So the DTAs are really that are due to the NOLs are eliminated. Right? Although this can be fairly complicated and acquirers try to get around this, but generally speaking, in an asset sale, acquirers cannot benefit from target NOLs. So any DTAs due to NOLs are eliminated on deal date. Of course, there are other reasons why you might have deferred tax assets, things like revenue recognition differences from book and tax purposes. And so those tend to carry over, depending on what they are, those do carry over. And so you have the issue of sort of having to make a decision, because often companies won't disclose what all their DTAs are due to. Sometimes they do, sometimes they don't. And so you have to make a distinction or make a decision about what you carry over and what you don't in the model. We're going to have to wrestle with that shortly. Just a fine point on the DTAs from NOLs, although the acquirer can't use the NOLs, meaning we eliminate it when we build a merger model, the target can use its own NOLs to offset the target's gain on sale on the date of the acquisition. But that doesn't actually have an impact on our model. It just has an impact on the negotiated purchase price because it creates a real tax benefit for the target. We're going to talk about that later on. Now, it's a little bit different when it comes to NOLs in a stock sale. Because in an asset sale, the acquirer doesn't get any NOLs. But in a deal structured as a stock sale, The IRS, so you can actually, the acquirer does get to benefit from those NOLs, but with a limit. Specifically, the IRS places an annual limit on the amount of NOLs that can be carried forward. And that limit is specifically defined as, on an annual basis, as whatever the purchase price is, times what's called the long-term tax exempt rate. Now, currently, the long-term tax exempt rate is around 3%. It's something that's published monthly by the IRS. The practical consequence of this is that when NOLs are significant, the DTAs have to get written down substantially on deal day because you won't be able to use all of them. But when the DTLs are not significant, you end up being able to use most of them. So again, the amount that you carry over and the adjustment that you make in your model actually kind of depends on the magnitude of the NOLs relative to the purchase price, and it's something you can bake into your model. So we covered a lot of stuff over the last several videos, a lot of stuff that may be fairly new. I suspect is fairly new to a lot of you. And so what we put together here is somewhat of a cheat sheet that helps you kind of put all this in perspective because there's a lot of moving parts. And so the guidelines down below obviously make, the disclaimer, make several critical assumptions about tax bases, which we don't have access to, and the nature of DTAs and DTLs. You, of course, have to consult with a tax professional to really hone in on what's going to happen in your specific case. But as general rules of thumb, we can say the following. In a stock sale, there is a change in the book basis in the same way that there's in an asset sale, there's a change in book basis. There's always going to be a change in book basis to reflect the fair market value. The question is always about the tax basis. In a stock sale, there is no change in tax basis. The assets do not get written up to fair market value. In an asset sale, there is the change in tax basis. That's the major issue that's driving a lot. Now, what that means when you get to change your tax basis, you recognize goodwill and asset write-ups. One huge benefit of the asset sale to the acquirer is that goodwill, future goodwill now that the acquirer is recognizing, is not only recognized on the balance sheet, that doesn't really matter so much, but what matters is that you get to amortize it and deduct it for tax purposes. So that's the case for an asset sale, certainly not the case here because for a stock sale, the IRS doesn't recognize the goodwill that's created in the deal. Again, for a stock sale, new deferred tax liabilities are created because these bases diverge, creating that DTL, whereas since there is no divergence in bases, they actually converge during a deal. No new DTLs are created. In fact, old DTLs are eliminated. In a stock sale, of course, no DTLs existing DTLs are not eliminated. The difference not only persists but is magnified, which is why we create the new DTLs. Switching to DTAs, deferred tax assets, what happens to NOLs? Are they usable in a stock sale by the acquirer? Yes, but they're limited under that IRC Section 382 annual limitation that we just talked about. And in an asset sale, they are not usable by the acquirer. Of course, they are usable by the target. They're usable, they are able to be used by the target. Non-NOL related DTAs carry over to the acquirer. That's generally the case in both stock sales and asset sales. Okay, in the next video, we quickly identify what are the key considerations for both buyer and sellers in a deal, and then we're actually going to get started with our real case study.